Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to Cycles TV. My name is Lars von Thienen. I'm host of the Cycles TV every week, every Monday, same place, same time. We are analyzing cycles in the global stock markets for the purpose of education and get a better understanding on how to apply cycle analysis to financial markets. That's the purpose why we are here every week again and again. So today I want to go over the current market conditions. So we will analyze the S&P 500 with the current market movements up to today. Based on the current situation, I will run you through the process on how to build and create a cycle composite forecast. So we will run through the basic procedure of applying the cycle scanner, spectrum analysis, reading the spectrum, picking the right cycles, building a forecast. And while you follow me going through this procedure, we will provide a year-end forecast based on the cycles for the global stock markets. This includes, as we are close to the year-end, also maybe a forecast or projection at least how next year might start. So that's it for today. It's a mixture of education, a mixture of real projection on the stock market, to learn something on cycle analysis. We are live today. I will be happy to take your questions in the chat section. Hello, I already see you there. At least at the end, I will pay attention to your questions. Before we start, still the analysis 2 and 3 weeks ago I did on cycles on the global stock markets is still valid. And if you have followed the analysis, I think beginning of November, you know that I projected between the 11th and 19th of November that most cycles roll over to the bearish point of view. So that's where we are today. That's what we have expected, the bear market rally to end exactly now. So let's see what the cycles tell us if we update it, while taking in account that the noise level is very high, but we will have this understanding now. We will take these serious and let's get to work today. So therefore we jump into our cycle analyzer. This is what is available to any member of the Foundation for the Study of Cycles. So if you want to apply this analysis routine, do this on your own, you're welcome. If you're not already, become a member of the Foundation. While as a member, you get access to the topics I will show you here. So let's have a quick view on the main situation. What we see here in the center, this is the current S&P 500 as of today, Monday 21st of November, latest price data. And we use, or I would recommend always to start with the last 3 years of data for the current analysis. I repeat this often, so I will keep it short. Don't use too much historical data if you're interested in the current cycle phase and length. If you use too much historical data, you will kind of average the cycle length and the phase, which is okay for long-term analysis, but in case of doing a concrete projection into the future, we really need to know what is the current phase of the current cycle status and the current length of the current cycle, not the average cycle length of the past 20 years, not the average phase we are in analyzing the past 20 years. That's always a different if you do a long-term analysis or short-term analysis. Here, if we are interested in the current situation, doing a projection, and using 3 to 4 years of daily data gives us enough data to detect cycles up to a length of, let's say, 350 days. That's always the average cycle length take into account. Have 3 times of data available for the longest cycle you want to be able to detect. So if we want to detect the longest cycle of around 300, multiply by 3, you arrive at a data historical length of around 900 data points for the analysis, which is sufficient to detect the current cycle. That's why I always recommend start with a length or historical data set of 850 to 900 bars. That's the standard setting. If you use the scanner, you can load more historical data, but your current projection might not become better. First starting point. Second starting point, on the right-hand side, you see the spectrum, the cycle length in days. We are using trading days in this chart here. So the length is measured in trading days, listed here in length. And each listed length here corresponds to a peak in the spectrum here down below. So for example, if we hover over a peak in the spectrum, so this current peak has a length of 279 trading days, and you see it's highlighted in the list in the lower right, the cycle length, which is corresponding to this peak in the spectrum. So that's the basic reading. So now starting, or the first question is always, which cycle now to pick from the spectrum? As you can see in the spectrum, there is more than one peak, and that's always the case. There is a combination of different cycles always active in whatever data series you analyze. So that's standard view, what you will see. Lots of peaks in the spectrum. Now the first question for a cycle analyst is to pick the best cycles to build a projection of. And the basic principle is look out for the sharpest peaks in the spectrum. So a sharp peak is a clear peak isolated in the spectrum. And I can give you 2 examples of the current view here. So for example, here in this situation, with a length of 180, you see a very flat plateau. Yeah, so this is a very flat plateau forming here. And to be honest, here is no clear peak. I mean, mathematically, you can detect the peak in the spectrum here. And it's exactly here. That's not the point, so don't get fooled by mathematics. But this is a very flat plateau here, so I would not trust the cycle length here. So this is a very bad peak. This should not be selected. While the good example is seen here. So here you have a very clear, very sharp peak, so and a sharp separation. So you see it goes down here to this point here and here. So you really have a clear separation of cycles with a sharp peak. So this one compared to that one here, this is a very good peak in the spectrum. And this is what you cannot easily see in the table of cycles. So that's always why visually inspecting the spectrum is important. So that's one rule. So, and the second rule is look for high amplitude. So the highest amplitude is always an indication for cycle strength. So we have 2 indications here. So here is a very, very clear separated peak with a high amplitude. So you see this is more or less the second highest amplitude in the overall spectrum here, besides this one, but I will talk about this one in a second here. So this is one important cycle to select based on the basic principles here. Now you might ask, why not picking this longer term cycle here, which has even a higher amplitude and the separation is okay for this length here. So this is also a good separation in the spectrum here of this cycle length. However, there are now additional measures which come into play to differentiate this peak versus the second peak here. And the key reason is what I call, or what is a measure, is the so-called cycle strength. And the strength of a cycle is defined by the amount of amplitude change per day. So how much does this cycle impact the amplitude change to the upward or to the downward moving forward one step in our series, and one step is one trading day. So, and then you can compare, without taking length into account, how much maybe does a shorter term cycle is responsible for price movements while moving one step forward, one day forward, compare the longer term cycle to a shorter term cycle. So maybe you will have the situation that shorter term cycles have, from an absolute value, have a smaller amplitude, like seen here. So the absolute amplitude is lower than this amplitude here. However, if you now compare and you divide just the amplitude divided by a cycle length, so you get the delta change per one cycle step here, this is the so-called cycle strength. And you will see, and this calculation is shown here in the so-called strength column, in the right-hand part of this cycle spectrum here. So this is the cycle strength as explained right now, and it's sorted now by highest strength here. So you will already see that the cycle with a length of 80, which is shown here, has the highest strength. And now, where is this longer term cycle here? I will hover over it. You see that the cycle, which is the absolute highest amplitude in the spectrum, 279 trading days, has a very low strength, even compared to the shorter term cycles. So it's listed at, I don't know, cycle 15, 16 compared or sorted by cycle strength. So why now deciding which of these two cycles to pick? It's clearly obvious. I told you that we can pick or choose between this cycle length here and this cycle length here. Both have a good separation in the spectrum, but the shorter cycle with a length of 80 has a much higher strength score. Therefore, picking the cycle with the length of 80 is the first important cycle to go with in this analysis. The final measure then, and I will explain even this at a later point of view, is the Bartels score, which we have not taken into account yet. So let's skip the Bartels score for a moment, I will get back to the Bartels score in a second. So I think now you got the starting point. So the cycle with a length of 80 is the most important cycle here in our analysis to start with. So therefore we will select this cycle as a starting point for our analysis here. Second, I will now explain what is the so-called, or this is exactly how the dominant cycle is defined. The dominant cycle, if you see this naming sometimes, is the cycle based on the current cycle spectrum parameters with the highest or the best strength score. And you can easily see the cycle strength or the dominant cycle if you activate the dominant cycle view in the analyzer, which will show up here down below with a length of 80. And if you activate the dominant cycle plot, it will show here at the bottom of the chart. It will only show you the cycle with a length of 80. So in this case, it's exactly the same because we have picked the cycle with a length of 80 for the composite, and the dominant cycle is here just shown below. Important topic to keep in mind is if you want to have the spectrum and the dominant cycle shown up exactly the same, you need to ensure that the settings in this configuration icon here are applied for the scanner and the dominant cycle explorer setting here, because otherwise you might end up in different findings here. But that's just a short explanation of what is the dominant cycle here. I think we don't need it here. We have it on our screen. You see the dominant cycle is close to, very close to topping. So you might argue, yeah, Lars, why did you show us beginning of November, I think it was beginning of November, to expect the cycle to top in starting 11th, 19th of November and then rolling over? Well, the dominant cycle with a length of 80 suggests maybe end of November, as seen here. And that's why beginning of November, there have also been other cycles which are still here, and I will now show you how to build a composite. So it's not only one single cycle you need to use. And as you're aware of last week's session, we anyhow have a lot of noise on these sharp daily moves we see in the markets, which makes any cycle analysis approach even harder to detect the cycles. We need to now find the best 5. That's always my recommendation. Not more than 5 cycles should build up a composite you use. You can activate more, but it does not make any sense. You overfit your cycle composite if you use more than 5 cycles. In most cases, even 3 might be enough. But in this situation where you really are not finally sure if there's just one single cycle, we need to add 2 to 3 cycles to build a composite, which can give us a clue and see if this composite gives us stable results in terms of when the future turning points are expected. If a cycle composite is flipping around in the future timing point analysis, we cannot use it. If a cycle composite based on the most important 5 cycles gives us valid timing points in the future, we can use it. So next step is now I will go with you through the period how to build a composite and why also in beginning of November I showed you that starting mid of November most cycles peak, not only these dominant cycle here. Okay, so how to continue? The most basic principle is now just use the top cycles with highest strength. Yeah, you can sort the list here based on amplitude, based on length, or based on strength. I would recommend start with strengths because these are the cycles which account for the most price movements, besides of the timing approach we are looking for. So if we follow this procedure, let's just go from top to bottom and just read the cycles here. So the next cycle, which would come into account from a strength score here, is 49. And now I would take into account also the Bartels score. You see here at the right, which is listed here with 45. This is a low Bartels score, and you see the 49 is also here. It's indicated with a blue arrow in the spectrum. A blue arrow in the spectrum means a Bartels score below 50, which is low. The Bartels score goes from 0 to 100, which is not the Bartels value. If you're aware of the calculations, the Bartels score is a quite more simplified. It's the same calculation but simplified reading, because we want to have it 100% is a high Bartels score, not the raw value, if you are familiar with the calculation, which means that a high Bartels score gives us high statistical significance of this cycle. It's a completely different measure to check the cycle. So first, it is detected by the spectrum. And then second, we use the cycle length here, in that case 49 trading days, and check the cycle length of 49 trading days against the statistical fitness test in the overall data set. A statistical fitness means that the cycle should be repetitive in the data series based from a statistical point of analysis, not spectrum or frequency analysis. I will not go into the details, but it's a different approach based on statistics to see if we can trust the cycle lengths. And everything below 50, I would ignore, because now we have different results. The frequency analysis in the spectrum says it is a cycle. The statistical significance shows us it's very low. So maybe there is a high one-time peak in the data series, but it's not repetitive. It's not seen enough times to be trusted as a valid cycle. So going from top to down, even high strength, I would not use any Bartels score below 50. Next one, 36, high strength, good Bartels score. Let's use this one. Then we have 38, good strength, good Bartels score. Let's use this one. Next cycle length of 70, Bartels score 67. That's okay. Now we arrive at the cycle length of 93. Here again, very low Bartels score, very, very low Bartels score. So then the 93 is here, I think it's the red one, yeah? So you even see it's a red peak. the red peak in the spectrum, which means the Bartels score is much too low to take this into account for any projection purpose here. So we skip the 94. Moving forward, here you could argue, should I use it or not? So first, let's go with it. Then the next one, 26, much too low Bartels score. And then let's end here, very high Bartels score, 128. So this was the last one to pick. We have 1, 2, 3, 4, 5, 6. We have even one cycle too much in our analysis. But what I want to explain is the procedure now. Once you found the dominant cycle, how to then pick the other ones without looking into the spectrum. It's just a pure simplified approach, which is always the same. So it's not any cherry picking of cycles here. It's a standard procedure how after you've known the dominant cycle, you know what you're looking for in the spectrum, moving forward, picking the next important ones. We are not at the final point here, but that's now the second important step. We now have built our first composite forecast here. As a matter of fact, but that's based on the cycle analysis anyhow, you see that the timing points in the past have a very good correlation, but that's part of the procedure here. You should not take too much account into the past, otherwise the cycle would have not been detected. And you see here now, and that's the point also, the result, what I told you in the early November Cycles TV sessions here. You see that the combination of these cycles, if you have a clear look at the current date, is the 16th of November. It's exactly in between what I always told you, between the 11th and 19th November. If you look at individual cycles before, they have been topping between the 11th and the 19th November. And if you just look at the peak here of this composite, it reads now 16th of November, so last week. I mean, that's an artificial peak here of a composite cycle plot. But you see from the current day, we rolled over last week. Yeah, so we have passed the cycle top. So instead of just looking at the 80 days trading cycle, which is topping end of November, you see that the composite out of simply picking the 6 most important cycles has rolled over. Now let's start to optimize our composite forecast here. By the way, I think you can start now to draw conclusions here. And that's always what I said. Almost all cycles roll over now into the negative period here until end of year. Yeah, so that's the first reading here before we get into account of the longer term cycles. So that's why I said it's important to be careful in the beginning of November with whatever rally might occur. I've not anticipated this large up move here, but it's now important where we are at the given point in time. Let's now optimize this composite cycle forecast. Next step, I said never take much more than 5. Now I've picked 6. So what's the next step here? So maybe you are aware of the phrase of cycle harmonics, which means that the harmonic relation between cycle lengths is always important, or you always have harmonics in play in a current composite. So you should look out for cycles which are in harmonic relationship to each other. And maybe if there's a cycle which has no harmonic relation to other cycles in our composite, we maybe should skip it, because you always, it's like in music, you always have a combination of harmonically related phrases, notes, sound, and same with cycles. The overall composite only should consist of cycles which have a harmonic relation in regards to each other. This builds up the best composite forecast. And in order to visually see the harmonics, we have the so-called Harmonics module. It's there in the cycle scanner, at least for advanced user here. So I will now hide the Harmonics module here at the bottom. And we can now remove the spectrum. The spectrum is always the first step to start with. Once you have gone through the procedure I described, now the harmonics come into play. What you see here at the bottom of the chart is the harmonics analysis, which when selecting a cycle here in the table, so for example, now I'm selecting or hovering over the cycle with a length of 80, and you will see in the lower left panel that the cycle 80 is highlighted in the center, and you will see with the arcs which are now highlighted, there is a relation to the 38 and 41 trading day cycle. So the harmonics can be defined in the configuration section here. So it's just a standard harmonics of 2, 3, half, and a third. So the opposite of harmonics of 2 is the harmonics of 1 half. So we're just dealing with harmonics of 2 and 3 here in that case, and allow a deviation of 8% because we will never see the exact harmonic relationship. So we allow a deviation of the cycle length of 8% to account as an harmonic relationship, which means, just looking at the cycle of 80, it has a relation 83 or 41. And if you see it in the table, 83 is here, but 36 has not a relation to 80. 36 has a relation to 70 or 109, but we have not picked any of these harmonic relations. So therefore, I would propose to skip the 31 because there's no harmonic relation in our composite right now. And instead, the cycle with a length of 80 has a clear harmonic relation to 38. So we can remove the cycle with a length of 36 trading days because it's from a harmonic perspective in no relation to other cycles. If you compare this to music or sound, if this note would be if you listen to an orchestra, it would sound ugly because there's the wrong tone, or one instrument is playing a wrong tone. It's like having a wrong cycle in a composite. You don't hear it. But that's the purpose of the harmonic analysis. You will see from the harmonic relation if it sounds ugly or if it sounds nice. So 33 trading days is not in harmonic relation with other cycles. So therefore, that's one reason you could remove it and just go with a cycle length of 38. So let's move forward to the cycle length of 70. We have an harmonic relation to 38. It's also the harmonic relation of 2 or half, having the 8% deviation allowed here. And then the next cycle is 64, which is a clear harmonic relation to the length of 128. So now you see all cycles which are picked here, 1, 2, 3, 4, 5. We have now 5 cycles in our cycle composite, which are valid in terms of strength, which are valid in terms of good Bartels score, and which are valid in terms of harmonic relationship. That's it. That's how you end at a composite with a maximum of 5 cycles in your trading account. And now you might even ask, what is with these long-term cycle of 279 trading days, which from a cycle spectrum? Let's also bring in the spectrum again. So here you see all 3 relations. I will now highlight the cycle in the spectrum in the lower left section, 279 trading days, which looks good in the spectrum, which looks really good just looking at the spectrum. But you see in the table on the right-hand side that this cycle has a very low strength compared to the other cycles. So the strength is much too low to use it, while the Bartels score is okay. Second, there's even no harmonic relation to smaller cycles in our composite out of 5. So we now have 5 cycles picked, but you can now check it against the longer term cycle of 279 trading days. There's no harmonic relation to one of the 5 cycles we currently have in this composite. So to be honest, there's no reason to pick the cycle with a length of 279 days, and the spectrum could have fooled us here. Yeah, so that's just why I want to run through the procedure of the different measurements we have in our cycle analyzer and how you need to combine the different views: the spectrum, the table, the strength, the dominant cycle, the harmonic relation, the composite, maximum of 5, the amount of historical data you need to take into account. That's the most important fundamental knowledge you need to have to apply cycle analysis. And now we have a composite which makes sense, which we can use for timing projection. So now we can make our view even more simple. So now let's just look into the current results or findings of our analysis here. So that's now the projection we did, and that's a composite, and that's why maybe you get the point. While even last week, as I explained, there is no change, and even the 2 weeks before, I told you that after 11th, 19th of November, cycles roll over. That's what you see in this composite here. I mean, a beautiful backtrack here, but that's again per design, nothing to count on. But now the projection. Now, how would this year end? This is what I promised also a little bit in the description of this intro here, and that's always what I tried to bring out here. So now we have a negative projection into the end of this year. I mean, this is in contradiction to the seasonal models, but this is the analysis of current time cycles here. Then there might be a slight positive timing point for January, but however, after the end of January, we are rolling in a negative situation until June. And I hope you are aware of the longer term cycles model from the weekly analysis, which points to a major low, or that the cycle downswing of the longer term cycle has not finished yet. So we are still in the longer term downswing, which why I would account for, if you trade cycles within cycles, this downswing is interesting and this downswing is interesting because these are the points in time here. So this is the timing window, which is interesting from here to here. And this is the timing window from here to here, which is interesting because there we have a cycles within cycles alignment from a longer term cycle and our daily cycles model. So from just reading cycles here, it looks like the current rally is ending from a timing point of view. I mean, you need to do your technical analysis on price. This is just time we analyze here. And then we need to be careful in January, but then again, time cycles predict. And then we get into alignment at somewhere in March, April. It will be interesting where we are if cycles move down. That's the projection I want to put out today. But not only the projection. Thanks for staying with me here the 30 minutes, because this channel is for education. So for me, it's much more important that you get the understanding how you apply cycle analysis. I mean, I know there are a lot of people out there who just want to see this composite here. So here you have it. At least we are not here to do any trade recommendation. We are just applying cycles, and we will learn from the analysis after the fact. But however, we don't fear to put forward projections into the future. So at least I don't fear it, even if I might be wrong. Everyone will be wrong at some point in time, but that's the current projection. That cycle analysis, that's important. And I hope you like it. Anyhow, today, it's a clear path from a timing perspective. This path has not changed since beginning of November, end of October. I need to be honest, the low here, at least from time cycles, have not been identified in this. So the last rally here was hard to identify by short-term cycles, but at least the current picture is more or less clear how to read it. That's it for today. A lot of knowledge in, to be honest. This procedure took me 20 years to come up, at least to get to this valid procedure day by day. And at least, even if there are other tools out there to apply spectrum analysis, cycle analysis, the knowledge on how to use it, prepare it, read it, pick cycles, decide cycles to pick, is often not available in whatever tools or procedures or tool sets you use. So therefore, that's the purpose here, or that's at least the topic I want to bring across here. So let's talk about some questions, or I will at least review your live chat section here that you get a chance to discuss. So I just need to cross-check the Brent. Could you repeat how you access the Harmonic Display? Also, it looks like the 36 day was related to 70 on the display. Yeah, that's right. So let's get back to this picture here. So let's clean up a little bit the I wanted to explain the energy model. Maybe I will come back to this in a second. But let's first talk about the harmonics. So the harmonics section is here. In the current user interface, it might be placed at a different point on the screen. This is the beta version of the new user interface I'm still using here to check it, to test it, to make it bulletproof. I promised also to bring it live, so I think at least before the year end, you will see this user interface come into play for the FSC cycle analyzer. And I hope you will see already as a preview that it gets much more easy to work with. So the Harmonic Display, you need to check your settings. So please go to the settings, advanced. Yeah, and you need to activate the cycle harmonics in the settings tab here and the auto composite. So in order to see it, go to the settings, go to advanced, activate cycle harmonics, which is required to see it on your screen. Otherwise, you will not see it. Step one, or at least your first question. Second question was related to the cycle length of 36. And yes, I agree. You're correct. It is harmonically related to the cycle length of 70. So and I overlooked that. That's correct. So there could be an argument to either also add 36. But now let's discuss. What's the difference of the forecast adding 36 or not? And therefore, I always have a look at the different outcome of the timing. So here, having not included this cycle leads to the current top here and a low here. So this is the timing we are interested in. And maybe then a top at this given point in time. So now adding the cycle with the length of 36, and you can see that even if I add this cycle into the composite, there's no real change in regards to the projection window. What is interesting here? So the slight change in composite, I will just add and deactivate it here, does not make a difference. And that's a good point. So you can add it or you can skip it, because anyhow it will not make any difference here. But at least good spotted. I think I was a little bit too quick in removing it from the list in regards to harmonic relation. Okay, so let's check some other questions. So the question of Emma, do you find larger time frame cycles weekly generally more reliable than shorter term cycles? For example, comparing to hourly data. The simple answer is yes. The more valid your cycle model is on the longer term data series, so I would compare weekly and daily. So for example, I would stick to 2 time frames. So for example, if you're more interested in the daily time frame, use the weekly for long-term analysis. And the weekly is, or the longer in general, is more stable. If you are in shorter terms, so if you are in hourly cycles, then use the daily as a long-term cycle and the hourly as a short-term cycle. And then in general, the larger of these two is often more reliable. The reason, and especially if you move down to hourly or intraday time frame series, because the lower the time frame, the higher the noise level. And that's a point I made last week. And especially if you go to intraday or hourly data, the noise level gets much more higher. And if I'm talking about the noise level, I mean the impact of one-time movements. So news, specific one-time events, or I don't know, special events out there, which is you will only see them on an intraday chart. Special events, news events, they will fade out on longer term series. So on the weekly, you will not see the impact of one large one-day moves. On daily, you might see them, and on intraday, you might see them even much more. So therefore, detecting cycles on even shorter term time frames gets more and more complex. So therefore, they get more and more unreliable on shorter time frames if you don't know how to differentiate between good and bad cycles for a composite. That's the point. If you have the knowledge to detect the cycles on shorter term time frames, which you should pick, to avoid falling into the trap of just analyzing noise, then it could be equally reliable. But in most cases, as it's not easy, due to a higher noise level on shorter time frames, the longer term time frames and cycle models are more reliable following this approach. Hope this is a basic guideline and basic answer to your questions, Emma. Okay, so what else do we have? Maybe, I don't know if I can, I think we can't solve it here. I still have problems with intraday data. I sent a mail. I will get back to the foundation. So I don't want to put out now my email address here for support requests, but thanks for bringing this to my attention. With what I just want to comment, and therefore it's important what I said up front. The lower you go on the time frame, and that's why I do not recommend it to cycle starters. So if you're new to cycle analysis, start on longer term time frames because the noise level is lower. If you're experienced in cycle analysis, you understand the basic principles of strength, Bartels, what the amplitude peak in a spectrum means, to pick these different cycles. Then you can move down to lower time frames because you are experienced and you have knowledge how to pick the real cycles. A second topic, and maybe this relates to your question on intraday, is you need to prepare the time frame of the past and the future. So often intraday data sets have gaps. If you don't have continuous data series trading 24/7, you will always have gaps in the intraday data set, and the cycle analyzer does not know per se where are the gaps of your intraday data set because trading times might be different from data set to data set. And you really need to go into the settings panel. So that's just a quick one, even I don't know what your exact problem is. But for anyone who goes into this intraday topic here, there is a session tab in the configuration where you can, especially for intraday, you can adjust the trading times. And it always starts with 24/7, which might be wrong if you upload your data series from the past, because the projection period will be derived based on what you put here as a trading session. So you can adjust this to whatever your trading session is, and then the analyst period or the uploaded data set will be equal to the projected amount. And that might really have a huge impact on the cycle projection. And that's a second topic, why we limit the intraday usage to more advanced users. It's not that from purpose of limiting features. You really have to have a higher level of understanding on what you do with your time frame, preparing the historical period, the forecast period, how you can adjust it in the cycle scanner, and picking the correct cycles. But at least maybe that's the general answer, which might help. Yeah, and maybe last but not least, David, and that's not only related to the CRSI indicator. This is now an answer. I will start with the generic answer. Once you know about the dominant cycle length, I explained in the beginning how to derive it. It's 80 trading days in that case. This gives you an indication on how to set up your technical indicators length, because almost every technical indicator on a chart has a length setting. And I often repeat this here, but have you ever thought about on a chart what to put into the parameter for the length of your RSI or whatever oscillator you put in the chart? Have you really found someone who told you which length to put in there? This is, I don't know, from the technical community. Nobody gives you really a clue what to set the length parameter for a technical indicator for. So, and that's why often these technical indicators get really worthless if you don't know to set the right parameters. Yes, you can backtest, you can do whatever data optimization to find the best setting based on breakdown analysis or whatever intelligence you use. But wouldn't it be better if you have a knowledge about how to set the lengths? And that's exactly what your question is about. The cycle length information can be used to fine-tune and set the lengths for any technical indicator, because the calculation of the technical indicator is in sync, in harmonic sync with the move of the main markets, which gives you much more reliable signals from a technical indicator. Or just told from the other perspective, it will really sort out all these whipsaw signals or these false signals from technical indicator, which will make any trading system a crash because of too much whipsaw signals. This will highly improve by using the dominant cycle length as input for the cycle length. And now the question, your specific question, should we use 80? In most cases, I recommend using half of the dominant cycle length, which in this case would be 40 trading days. If you specifically ask for the CRSI indicator, which I provide for free on a TradingView and in my books, it always includes halving the dominant cycle. So yes, you can use 80 as input for the CRSI, because in the routine itself, or if you use the pre-built CRSI indicator, it will use half of the length automatically. If you do this for other technical indicators, use 40. That's at least I hope, the answer. Okay, so I think these at least are the most important answers I could put out today for you. Oh, we are running 45 minutes again, so long time. But I want to bring this into one session. Knowledge, how to build a composite, analyze current markets. No real news if you have followed the November news. So let's see what happens until end of the year. I will update you here next week, Monday, same time, same place. For sure, the standard procedure: like, subscribe, recommend, comment. Whatever you want. This helps us to grow on YouTube, which is important to run this channel for free and bring you the education forward here. So have a safe week. Stay safe. I would like to meet you here next